Well, hello everybody, and welcome to Goal Setting for Executives and Individual Contributors. My name is Chris DiCenso. I will be presenting today. We're trying something new today. We're trying a 30-minute webinar, thinking we might find more people because your time is definitely constrained, and it's actually shown up in the registrations. A lot more people today. Because of that, it's going to go a little quicker. So for those of you that may not be used to the Northeast speaking the style that we do, the speed that we do, you can watch it over and over again. We are recording it. I do encourage you to send us some questions throughout, and we'll follow those up best we can. It is going to be very technical as we get into goal setting. We're going to actually get into some technical, at least quantitative design of how you set goals. So you know who's listening today. We actually have basically all leaders, whether it be supervisor or above usually, but mostly presidents, CEOs, some VPs, a combination of manufacturing, distribution, and services, and we actually have some lawyers. Some of the faces, or I guess names, are very familiar, and there's some that are new. So welcome to everybody today. What we're going to do, and the goals for today are this. I want to educate you on why, a little bit of why do you want to set goals, but more importantly, how do you do it? And how do you do it, and what tools might be available for you to do it and make it more effective for you? Paul is on the right. I am the one on the left. Paul's not here today. Paul's actually sick, so you're going to have to listen to me all day. The two things I want you to take away today as we go through this are A, if you have realistic goals, they will drive performance. Okay, higher performing companies are definitely a performance-driven organization that starts with goals. The second piece is that this is a process. It's not something you do and it's done. You're continuously refining the goal-setting process. As an engineer, everything to me is process-oriented. So keep those two things in mind as we go through. What we're going to talk about is why do you set goals? How do you set goals? We'll talk about how do you set goals for executives and individuals, and then we'll wrap that up. Now, a little quick thing about Growth Strategy Partners, management consulting firm, work with privately held companies to try to grow their revenues, profits, and talent. What's special about us is our ability to implement quickly, and we do that, we can do that because we've identified what drives growth, these 7 keys that we talk about. We built these tools that you'll see today, or stolen them from other educators. And our consultants are past, present, CEO, been there, done that. So that's our ability to bring in and grow your businesses faster. So let's jump into goal setting. A very common acronym you may see out there is the SMART acronym. Goals should be specific. And I'm not a big fan of acronyms. I think people try to create the acronym, then figure words to go with them. This one's not bad. Goals should be specific. They should be measurable, so you know how you're getting there. Agreed to by the people setting them, the team, the organization, the executives. They should be actually realistic. This is where we'll talk a little about today. Most goals may not be realistic, either low or high. And then time-bound. How do you get them done? So that's somewhat going to be a little bit of the framework as we get in today, but it's going to be a little more detailed. Now, before we jump into the guts of this, I have a question. Actually, it's a poll. And I'd like you to answer the question so we understand the audience here. You have defined goals for what? If you would start clicking or answering, do you have your goals at the company level, the leadership, down all the way to all employees? So if you start clicking on that, let us know where you have goals, and you should be actually to click on multiple. So if you have it from the company all the way down, you click on the top and on the bottom. So get a sense here of what we're dealing with relative to goal setting and what people listening today have. The assumption is you're looking to get better, which is why you're here. I'm going to take about, let's see, we got about half voted so far. I'm going to take maybe a few more seconds. We get more people to vote. And we'll take a look and see what do people have here. And then we'll talk a little about what you're looking for. So again, if you have questions specifically, it only allows you to select one. Sorry about that. I thought it was multiple. So if you have everybody, you can pick the bottom. Everybody's voted, so let's do this. I'm going to close this up. And let me make a note here. Close it up. And I'm going to show it to everybody, but I have to write down the answers before I do so I can see it and share it. There we go. So what you should see is a mix all the way through this. Most have goals at the company level, which is great. Very small percent at the executive leadership level. So we'll actually show you some things today that you can do specifically in that area. The directors, managers, next level down, most supervisors and employees. If you look at this, it's a third. No one, a third or less have goals here. So that's interesting. I'm surprising. I thought actually it'd be a little higher, but that's probably why you're here. So let's go back and look at the content and help you set goals. Why do you set goals? Bottom line is goals drive performance. If you don't have a goal, whether it be at the company level, the individual level, in business and personal life, what are you trying to achieve? And it's been proven that companies with goals are more likely to achieve higher performance. I'll talk to you today about a live example of a client of ours where before we got there, they had no goals. We worked with them in a lot of different areas, but goal setting and execution was one of them. And they basically went from break even to a 6% operating profit in 2 years. And we built a culture around goal setting and continuous improvement, and that was the big piece of what made this successful. So again, I'm not going to belabor on why to set goals. They are extremely valuable, and if you don't have them, that you're going to be probably a lower performing company, but again, that's why you're here today. So where do you start? How do you set goals? Goals should be set at the company level. Ideally, the organization has some corporate goals, company goals, organizational goals, which are then cascaded down to the executive team, leadership team, which are then cascaded down to the individuals, the directors, the managers, supervisors, and then individuals. So ideally, it's a cascading effort, and it starts at the top, because if you don't have corporate goals, then what's your next level supposed to be doing? So it's got to start at the top and be driven down. So how do you set them? I mean, that's great, Chris. You set them at the top down, but how do you do that? All right, so here's typically what happens. You've got a company that is performing at a certain level. It's growing. And now they want to set some goals. And a lot of times, again, we look at the history and we say, we've been growing at 5%, so we'll just continue, and our goal will be 5%. The other option is that we often have owners go, man, that's not good enough. We need to be twice as big or twice as big in 7 years, 5 years, pick a number. And they establish what they would like to do, which is this higher growth goal. It's the what I'd like to be goal. Now, neither one of these are right or wrong necessarily, although I'm definitely more skeptical on the what I'd like to be goal than the historical goal. But really what's important is what's been happening historically is one piece of the equation. More importantly is what's going to change in the future, and maybe what occurred in the past to get to you where you are today, and then is that going to continue in the future? So if you've been growing 5% revenues, let's say, for the last 20 years, yeah, you could probably make an assumption that it's going to continue at 5 going forward. If you now think it's going to be 10 or something significantly more than 5, my question is, what's going to change? What is going to happen strategically and tactically to make that growth differently or you achieve that goal? So what we end up doing is suggesting that what I call the sandwich or the squeeze play, which is, you want to drive something above historical growth, because that's what we're trying to do is do better. But what you're stretching for may be too much, and therefore maybe you sandwich it, or I call it a squeeze play at times. It's something in between maybe what you'd like to do and maybe what history has been. And here's some examples. We actually did some work with a wealth management company, so a company that manages people's wealth and assets. They were growing at 12% for the last 4 or 5 years, and they wanted to accelerate that growth, and they were setting a goal of 15%. Now, when we looked historically to figure out where that 12% growth came from, revenue growth or net asset value for them, historically, we found out that 6% of that 12% was because of the stock markets growing themselves. They didn't add more customers or bring in more money. It was simply that the market itself grew 6%. So half of that growth came from nothing they did at all. It was market. Therefore, trying to set a 15% growth, not that it's not doable, but they need to understand half of the historical growth came from them, basically from the market. So what's going to come from basically, what's the term people use, the rising tide floats all boats? What's going to happen that's going to drive the market growth, and then what are you going to do differently to make your growth even faster? And so this is the big question here: is what are you going to do that's differently? And that's really the big thing. I'll go back to that the client we talked about. From a one-year perspective, we started talking about driving profitability from 0 to 1.25%, and they actually achieved 1.5%, again, because of what we put in there to make that happen. Let me go now and get a little more specific with you on this. So again, we're setting goals. First of all, this is getting into the goals being realistic. So when you set goals, ideally you set goals in levels or tiers. So it's not a make or break or win or lose situation. So here you've got some what I call levels of performance where you've got, let's say, sales dollars. So let's say a company wants to achieve 10 million in sales or an additional 10 million in sales, whatever the case may be. That's the 100% target. What we've done is suggested that you ratchet that down 20% and up 20%. So make a variance, 20% below it and 20% above it in terms of how those goals can be reached. So, and this again, we'll get into linking this to the bonus pool or incentives where nothing is achieved until they hit 80% of that goal. So in this case here, if the sales goal was $10 million, the executive team or whoever would achieve a bonus payout of 80% if they hit the 8%, $8 million number. If they went to higher than 10, say $12 million, they would get a 120% of bonus. And what this allows you to do is it's not, again, a make or break situation. And we'll talk a little about the linking of this to bonuses in a bit. So now we talk about setting goals. So we've identified roughly, the sandwich play, squeeze play, if you will, and some numbers. And again, I'll get into an example about the stretch component of this, or how do you set that $10 million or that 3% defect rate. So let's talk about bringing this down specifically towards executives. That's a lot of people here needed some executive goals. Executive goals should be linked to corporate goals, right? What's the company trying to achieve? Therefore, the executive should have those goals linked to it. We're going to talk about revenue goal and profit goal at the executive level and how they all should have a component of that. And then we'll also talk about the hard and soft piece of this. So the example we're going to run through here is you've got a company that wants to increase its profits by 2%. And what we're going to do is drive this now into the operational, to the head of operations goals. These are actually live examples of a client. And so if the company was going to increase profits by 2%, then what's operations or the head of operations going to do to contribute to that 2%? And this is just a piece of this. But this person's goals, a big piece of it was reducing the material cost of goods sold, reducing the labor costs per pound, reducing a defect rate, and implementing an ERP or a computer system by a particular date. These aren't the whole things. I'm going to show you all of it when we're done. But what we're showing here was that at this point in time, this now is saying this, at the time the goals were set, material costs were 78% cost of goods sold. Yes, they were high. The target was to get it to 75%. But we were going to offer a partial bonus if he got it to 75.5, and obviously if he exceeded that, there would be a higher payout. So what we're doing now is we're taking the executive goals, the corporate goals, and linking them to an individual's goals. And hopefully you can see the linking and what those payouts, or the targets would be. Now, in different cases here, you'll see in terms of percent change. You'll see a much bigger percent change or goal with the labor costs going from 42 cents a pound to 36 cents a pound than you will in the cost of goods sold going from 78% to 75%. And the reasoning and thinking behind this was where the company did some analysis to figure out where's the greater opportunity. And basically what they were making meats, the windows of opportunity in meat buying and reduction in cost was a lot lower than where the labor costs were. But it was a big piece of the component of the cost of goods sold. So now, if you look at these executive goals, now what we do, I'm going to start linking in the bonus program. All goals are not equal. All goals should not be equal. In fact, I will get off on a tangent of when you see job descriptions and it lists 25 things that someone's supposed to do, and I guess they're all equal. They're not all equal. It should be clear of what the priority is for someone and what they need to do. So in this case here, we have this weighting factor or an importance factor, which shows that the reducing material cost of goods sold is this person's most important goal, and it actually is weighted at 25%. So 25% of this person's bonus is going to be paid out based on them meeting 80 or 100 or 120% of this goal. And then you can see the rest of that, 15% for labor, 5% from defects, and 5% for an ERP system. That makes up to 50% of this person's goals, which is also what we'd link now to the department goals. Now let's continue this. So we're going to get into the department piece, but what about the rest of the executive? Well, we always include interpersonal or leadership development in the 10 to 20%, depending upon what the needs are of the individual. Okay, so this is where they're going to look about leadership training, conflict resolution, maybe educational understandings from financial perspective, presentation skills, communication skills. Then we've included a company revenue goal and a company profit goal. So what you'll see here is that this operations executive has 20% of his bonus linked to the revenues and the profits of the company. This links everybody together, which we think is very, very important. So now let's move this down where we now put the whole executive team together. That was showing you what one executive did. Let's pull the whole team together. This is actually something that I was part of in an earlier career. What you'll see is across the top, you'll see all the goals for the company. So revenue, net income, existing customers, reduced cost, and there was obviously some numbers linked to this. And across the vertical axis here, you'll see basically each member of the leadership team. What we do in the middle here is identify what percentage of that person's bonus is linked to achieving that goal. Now, the first reaction we usually get is, well, wait, now you're telling them, what everybody makes. Nope, we're just showing that if someone achieves their bonus, first of all, the whole leadership team is linked to the revenues and net income. And then, where's my ops guy? Okay, 45% reducing costs, 5% improving quality, there's your 10% people. So that's the 100% bonus. And it's basically showing the alignment of the executive team relative to what their goals are and how they're going to get paid. And just because of time, I intentionally made a mistake on this, meaning there's something that's wrong here. I don't know if you can pick it up quickly, but I'll give you the answer because we don't have time, which is if you look here at existing customer sales, you'll see that the head of sales has 10% of their bonus linked to the goal of selling to existing customers. But no one else in the leadership team is linked here. So how this works is the head of sales would go, wait a minute, I've got a goal here that no one else is going to help me achieve. You see many of the others, there's other executives helping them achieve it. That's the alignment piece. So this is a great tool, we think, to help get the executives on the same page without necessarily sharing, what their bonus dollars may be when it's done. Okay, let's get into the individual now. Individual goal obviously should be linking from the company goal to the executive goal. So the example, again, I'm going to continue with is this company that wants to increase their profits. I guess it'd be better than reducing it. 2%. You saw the executive operational goals, which included material, labor, and quality improvements. Now we've cascaded them down to the production manager or quality control manager. So on the production manager side, he's got increase the yield. So the thought was, if we increase the yield of what goes out the door, that's going to reduce cost of goods sold. You'll see that the QC manager has that same goal, so there's alignment here. But the production manager has a labor component where the quality control manager is focused on material setup used, which is a quality, a defect rate. So now what we've done is we've taken these individual goals, taken the company goals, linked them to the executive goals, and then brought them down to the individual goals. So that's now what I'll call the cascading system, so that we can drive company goals to executive goals to individuals. Now, often though, when you get down to maybe the general employee or below supervisor, the question is, well, how do you do stuff with them? I would still use the same type of cascading approach, but usually get into more softer goals. Okay, so there's a combination of quantitative goals and qualitative goals. What we've developed, basically stole and modified, is a 2-page form that gets us into some soft goals like leadership and accountability, dependability, decision making. You'll see a list down here of others that we've used. I just didn't want to make the print so small you couldn't see it. And we'll have maybe 5 or 6 of these characteristics for the individual. This is maybe now the hourly worker or maybe a salaried worker. Some of the engineering firms we work with, they've got some salary people, but we can definitely drive their goals from this form. And what you'll have is a rating system from outstanding to not effective. And now what we'll do is, when we build the company goals, cascade them down to the executive, to the department, and then the individual, we may set a couple individual goals like we showed you before. Go back here. And then add to that some of the other softer, non-metric driven goals like leadership, dependability, and decision making. The other thing that we're going to do is we're going to put the personal development plans. What are they going to do to get better? What are they going to do to achieve those goals? What performance do they need to change? What traits or characteristics that might need to be changed to achieve this? Now, one thing that comes up often is, okay, great, how do we set these goals, individual goals, without having company goals? You can do that from the ground up at times. The example, we were working with a shooting sports company. They had a large defect rate at final testing. And the reason was there were a lot of blemishes on the firearms. They were scratching them up, actually to the tune of 50%. So we could actually work with the people in final assembly and test and identify that they need to reduce that 50% reject rate. In fact, we set a goal of half of that. And then we established how that could be done, which mainly came into the handling of how they handled those guns going into final assembly. So that's the individual goal setting form. The other thing that helps with this is when you have reviews with someone, we're not going to get into the reviews in great detail, but when you have a review with somebody, usually they want to know some specifics like, well, wait, when did I do that? You did a good job. Remember when you did that great project? Remember that time that you didn't deliver it on time and you as a supervisor are trying to figure out, wait, when was that again? And quite often, the week before the review, you start writing the stuff down. We've created what we call a plus-minus sheet, which we think is very helpful when it comes to reviewing the performance of individuals. What it does real quickly is you set a date. When something happens, basically it's a piece of white-lined paper that you have in a folder with someone's name on it. And when they do something good, you write down the date, you write down what they did, and you have this little plus-minus to see if it was good or bad. And you track those, once a month, once every other month. Whenever something significant beyond the everyday occurs, this now helps me in my role review my employees because I know what a specific thing they did and when. This is really going quick. I'm learning this 30-minute thing doesn't give me a lot of time. Measure performance. How do you know if someone's achieving their goals if they haven't measured their performance? So again, we can spend an hour on performance measurement, but we don't have time. So if you measure it, and that was part of the SMART piece of being specific and measurable, you got to measure the goals. Let me end. I've actually got one more poll I'm going to ask people. And we'll do this, and then we're going to wrap this thing up. And if there's any questions, please put them through. I got a few showing up already. Question I have for you is, what's your challenge going to be in building a goal-setting program? So if everyone just, now you can click on one, you only have one. What's the big challenge you're going to have? Is it knowing how to put the program together, putting in a priority? You don't have company goals, so how do we set individual goals? There's a culture piece. I see a lot of people doing that. And the bottom is basically saying, you know, we're actually working on implementing. We have a good program. We're just looking to listen and refine it. So why don't we do that? And then I've got 3 minutes left, and we'll wrap this thing up real quickly. Man, this goes by fast, even with a fast-talking New Englander. I'm seeing most people are getting the implementation. We've got most of the votes here, so I'm going to close this thing up and write my answers down. Okay. So I'm going to close it, and I'll share it with you. And you can see that most people here are in the implementation on the bottom. We're looking for ways to implement. That's great. That's great. As I saw the earlier poll, which showed the executives were lacking, that's probably where I'd focus the efforts. And you've got classic making it a priority and the culture of leadership. I'm actually happy that's low. Usually that ends up being a big challenge. So let me wrap this up and see if I can get a question or two before we close this. In fact, what I'm going to do, I've got 3 minutes left. And what I'm going to do is I see one question that I saw. How do you know if your goal setting is good? How do you know if you're setting good goals? Great question. And I look at it from an engineering perspective as a variance analysis. When we early on started working with companies, even with our experience, the goals that we would set, the achievement of those goals would have a large variance, i.e., you know, it would be 40–50% above or below what we were set, because it wasn't, setting that goal can be challenging at times. So you're getting better because of one or two things are happening. That variance is decreasing. Basically, you're setting your budget and you're setting your goals and you're achieving them because you have a better understanding of how it works. The bigger piece is you're getting better as a business. Your performance is getting better. So that's the main thing I would look at. Because of time, I don't have a lot of, because of lack of time, I don't have a lot of time for executives. So what I'm going to do is tell those that did put questions through, I'll try to get back to them individually. And what I want to do is wrap up. Goals are needed. If you do not have goals, you generally will not improve, or you'll improve better if you've got goals set. You've got the SMART acronym. I would focus on the alignment, especially at the executive level, that they're realistic. This is the big thing, that and that you can measure success. I would encourage you that it's a process. So if you do it once, it doesn't work, don't give up. You've got to then refine it year after year. As we went to that meat company example, in the third year, we were right on. It was more predictable on what we were going to achieving for our goals. And it does come down to you in the implementation of this. People, unfortunately, we all talk about, well, fortunately, we say people are very important, but then we don't put a lot of effort into managing them, whether it be goal setting and mentoring them. So this is what I encourage you to do this and drive it yourself. Ways we can help. Again, if you have questions on this, those that have sent the questions in, I will reply to you individually. Obviously, what we do is build strategic plans, and we've got some quick start programs on setting executive and individual goals. So this was quick. This was a quick learning for me. I've got 1:30. I want to keep it on time. I want to thank everybody for attending. This has been recorded. It will get up maybe by Friday. I will send the presentation out. I will leave the document open for a few minutes. If people want to ask questions, they can do that, and I will follow up with them. So thank you very, very much. We hope you have a great day.